Good afternoon. This is Kyrill with Centerfin Capital, and this is our weekly collective for the week ending July 5th, 2024. As always, we'd like to highlight a handful of things that happened this week that may be relevant as it pertains to business and markets and investing. This week, we're going to discuss the stock market performance for the first half of the year. We closed the second quarter at the end of last week, and so we'll discuss what we've observed and what that might mean for the second half of the year. Second thing we'd like to discuss is this week's economic data. Even though we had the July 4th holiday, so it was a shortened week, we did see some important economic data, and we'd like to bring that back again to how that pertains to markets and what we think that might mean going forward. And last but not least, we'd like to talk about the fact that 2024 ushers in democratic elections in almost 100 countries globally. So something like half the global population is going to vote for their governments this year. And there are certainly some trends we can glean from that and bring it back to what that might mean for the economy and for stock market. Starting with the stock market, the second quarter closed, as I mentioned, at the end of last week. The S&P 500, which is a broad gauge for the stock market in the U.S., was up 14.5%, which is a very strong start to the year. NASDAQ was up nearly 17%. However, the Russell 2000, which is the index of the smaller companies in the market, was only up about 1% for the year. And the Dow Jones Industrial Average, which is an old index of 30 companies that has a much lower weighting of technology in it, was only up about 3 to 4%. And so when you break down what that means, obviously, stock market being up 14.5% for the first 6 months of the year is a very strong performance. However, when you look underneath the surface, what is really, it's one small subsector, one big sector, technology, and one small subsector, semiconductor companies, that are driving almost the vast majority of those gains. When you break down the kind of subsectors of the S&P 500, what is the semiconductor index, so the ETF that contains all the semiconductor companies, NVIDIA, Micron, and others, is up almost 50% on the year. The QQQs, which is the 100 biggest companies in the NASDAQ, which is very technology heavy, was up close to 20% on the year. Both of those significantly outperforming the overall broad market index, such as the S&P 500, which was up 14.5%. If you look underneath the surface, beyond the semiconductor names, financials were up about 10%, energy was up about 10%, healthcare was up 7.5%, industrials were up 7.5%, materials were up 4%. Everything else basically underperformed the index, which just shows you that really what drove the index was technology, and more specifically semiconductors. That doesn't mean that this is not sustainable, but what it means is that either the other companies need to catch up, or if we have a reverse in some of these trends, it will be a downdraft for the market. What was really notable to us is if you look at the performance of gold this year. So gold for the first 6 months of the year is up 12.5%. Gold is priced in US dollars. Generally, gold is strong when the US dollar is weak. What was interesting and notable is that the US dollar is actually up a couple of percent versus a basket of other currencies for the year. And so gold is up despite the fact that the US dollar is strong. We think that's telling us something. Again, we've been very focused on the US fiscal situation and the deficit we've been running. And we think gold might be smelling that there are potential clouds ahead, clouds forming. And so really, to sum it all up, we have a stock market driven by a very small part of the market, an important part of the market, semiconductor stocks. And we have gold up despite the fact that the dollar's up. And those are notable takeaways from the first half of the year. If you look at statistical trends, when the market is up significantly in the first half of the year, it's usually up for the rest of the year. However, and in addition to that, usually the stock market has a strong year in an election year. However, if you look at this year, some of the things that we just mentioned, the fact that the stock market is being led by a very small amount of companies. We have also an election that is not very common. We currently have 2 candidates of the major parties, but one is in question. And so that's going to bring uncertainty for the rest of the year. And we think that the stock market looks very strong, but is probably vulnerable to the downside in the second half of the year, just given where valuations are and the makeup of the current rally. Obviously, nobody knows anything, but we're just making observations and giving it our best guess. Next, we'd like to discuss the economic data this week. So even though, as I mentioned, it was July 4th week, we did have some important economic data, most importantly around the health of the labor market. Earlier in the week, we had the JOLTS, which is the number of job openings out there. That data came in came in below expectations, which basically means there's less job openings than we were previously experiencing and expecting. And then we had a jobs number on Friday this morning, that was at 206,000, which was slightly above expectations. But the most notable thing about this data point was that the prior 2 months were revised down by over jobs in total. And so we're clearly seeing a weakening in the labor market. And this is what the Fed is paying attention to and the markets are paying attention to. Now, we also saw inflation data this week. The PCE deflator came out. This is the Fed's most favored gauge of inflation. And that came out at 2.6%, which is as expected. Not quite at 2%, which is the Fed's target, but obviously positive for the markets because the markets are really focused on whether or not the Fed is going to be able to cut interest rates. All that data, actually, while it sounds negative for the economy, is actually positive from the perspective that the Fed will cut interest rates. There was also some real-time GDP data from the Atlanta Fed that showed that the economy was still growing, but albeit at a slower pace. It seems like all signs lead to the fact that the economy is showing signs of slowing, which is good from the perspective that the Fed will have more leeway to ease. However, it's negative from the perspective of the fact that the economy is slowing, and that's generally not good for the consumer. It's generally not good for earnings of companies, which is obviously how companies in the stock market are valued. Again, we'll see how this all plays out, but just giving you guys an up-to-date picture of the economy and how it relates to markets. And then last but not least, we wanted to highlight something that we don't think is broadly known, but 2024 is an interesting year in that almost 100 countries will hold elections this year. Democratic countries, obviously, will hold elections this year. So nearly half the population of the world, about 4 billion people, will vote this year on their government. Obviously, we know about the U.S. presidential election that's coming up in November, and we've recently seen the U.K. held elections yesterday. France is in the middle of elections. Many other European countries will have election before the end of the year. One of the largest by population countries in the world, India, will hold elections later this year. And so it'll be interesting to see if we can glean any trends. But we think probably what the most likely thing is that given the incumbents, the leaders in government in the various countries that we're talking about have been in power in the post-COVID period, or maybe even during COVID, and we've seen inflation, which is a big problem for most of the population, we think that we'll see incumbents challenged by whoever the challenger party is and the challenger candidate is, and we'll probably see a turnover in government. Now, in the UK, what we just saw yesterday was that it was actually the Conservative Party was voted out and the Labour Party, for the first time in a long time, overwhelmingly won. This was projected to be the case, but I think what was unexpected was how overwhelmingly Labour took over the government in the UK. So that's going from a right-leaning government to a left-leaning government. However, in France and in many other countries, what we're seeing is the right-leaning candidate, or the equivalent of the Republican-type candidate in the U.S., seems to be really the challenger. And like we said before, we think that the challengers are going to have some potential tailwinds because the incumbents have presided over this period of inflation, which was generally not received well by the population. And so these are things to keep in mind because right-leaning candidates tend to be more nationalistic. They tend to be stronger on border. They tend to be obviously more apt to engage in conflict with bordering nations and with other nations globally. They also tend to be, generally speaking, not exclusively fiscally conservative, meaning that they're all for lower taxes and lower spending. However, we think, at least if you look at the picture in the U.S., if Donald Trump comes into the White House, we do not think he's a fiscally candidate. He will probably spend, just like he did in the first election. And what we think that means is that the fiscal situation in a lot of Western countries will continue to deteriorate. Speaking in the U.S., we're running a massive fiscal deficit. We have been running a massive fiscal deficit during peacetime with the economy chugging along. Usually we run a deficit when there's a crisis or war, and we've been doing it in peacetime and with an economy that's been strong. This is very rare. It's bad for inflation, obviously, and it's part of the reason we've seen inflation be a problem. And if we do have governments out there that are going to continue to spend in their economies, we will see continued deterioration of the values of their currencies, and that is potentially bad for inflation for the domestic populations. And again, tying it back to the performance of the first half of this year, with gold being up 12.5%, we think that might be sniffing out what's to come down the line. That's all we got for you today and for this week. We hope everybody had a nice 4th. We hope everybody has a nice weekend, and we will see you next week.